Welcome to the Explainer. Today, we're going to look under the hood of the ultimate barometer of the US economy, and well, we're going to uncover a bit of a hidden reality. When we think of the stock market, we're almost universally pointed toward one single benchmark. It's basically the gold standard of American corporate success, right? But underneath the surface of that benchmark, the very structure of the market has profoundly shifted. It's created a dynamic that most everyday investors are, honestly, completely unaware of. Get this, just 10 companies currently make up roughly 40% of the entire S&P 500. So we've got this massive contrast between the idea of broad diversification and a reality of, well, extreme concentration. I mean, really think about that for a second. Out of 500 of the most significant companies in the United States, companies that are supposed to represent a vast cross-section of the whole economy, nearly half of the index's total weight is being driven by just a mere handful of corporate giants. It's wild. All right, so here's our roadmap for today. We'll start by getting the S&P 500 explained, then we'll look at how market cap weighting works, analyze this big tech concentration, examine the current market and the massive AI boom, and finally, we'll look at the reality of passive investing today. Let's get into it. Starting off with Part 1, the S&P 500 explained, the ultimate US benchmark. So to understand what's happening right now, we really need to understand the foundation of the S&P 500 itself. It's considered the ultimate gauge of U.S. equities, and it actually captures about 80% of the total U.S. equity market value. But it didn't start that way. The index has evolved over a century and a half. It started as just a simple railroad guide published by Henry Varnum Poor way back in 1860, and it eventually became this 500-stock powerhouse. By 1923, Standard Statistics had developed a weekly index of 233 stocks. Then, after a merger to become Standard & Poor's, the index we all recognize today was officially born in 1957 when it expanded to 500 companies. And the whole purpose from the very beginning has always been to capture the evolving landscape of American industry. But here's the thing, a company doesn't just automatically get added to this list just because it exists. Unlike some strictly rule-based indexes, there's actually a dedicated committee that strictly filters these 500 companies based on some pretty tough criteria. To even be considered, a company absolutely must be domiciled in the US, and it has to boast a massive minimum market capitalization of $22.7 billion. On top of that, it needs to demonstrate positive earnings over recent quarters and maintain high market liquidity. So this whole process essentially ensures that only the absolute most robust corporations actually make the cut. Moving right along to Section 2, let's talk about understanding market cap weighting, which is really the core mechanism here. Okay, so this mechanism is exactly where the illusion of an equally divided pie begins to fracture. The truth is, the S&P 500 is not equally divided at all. Rather, a company's physical size directly dictates its influence and pull on the overall index. We call this market capitalization weighting. Basically, if a company is incredibly valuable, its percentage allocation in the index is going to be significantly higher. Because of this, just a 1% price movement in a giant company alters the total index way more drastically than a 1% movement in a smaller company sitting near the bottom of the list. Now, if we compare this to the Dow Jones Industrial Average, it illustrates exactly why the S&P 500 structurally favors those massive corporations. You see, the Dow is price-weighted. That means a single share's high stock price is what gives it more influence. But because the S&P 500 uses market cap weighting instead, it becomes a direct reflection of aggregate corporate scale. In other words, the bigger you get, the more gravitational pull you exert on the whole thing. All right, Section 3, the big tech concentration and the hidden imbalance we're seeing right now. So, this market cap structure has led us straight to our current reality, which is an incredibly top-heavy market. When companies succeed and grow, they literally consume a larger percentage of the index. And looking at the current breakdown, it reveals a completely staggering imbalance. The top tier absolutely eclipses the rest of the market. To put that into perspective, historically, the top 10 companies might make up maybe 20 to 25% of the index. Even at the absolute peak of the dot-com bubble back in the year 2000, concentration never reached the levels we're seeing right now. Today, those 10 biggest companies command roughly 40% of the index. That leaves the other 490 companies to just kind of split the remaining 60%. It's a massive shift. So the really crucial point here is that investors are paying a massive premium for these few tech giants. They're betting heavily on years and years of future growth. If you look at a price to earnings or PE ratio, it basically tells us how many years of current earnings an investor's willing to wait just to make their money back. And when you see ratios like Nvidia at 44 or Tesla historically hovering somewhere around 410, well, it's pretty clear that the market has baked in some truly extraordinary expectations for uninterrupted, rapid expansion. There's a quote that really hits the nail on the head. We are removing price discovery from equity markets. And what that means is this concentration creates a self-reinforcing cycle. Because passive index funds buy automatically based on a company's size rather than its underlying valuation, it creates this crazy feedback loop. The biggest winners just blindly attract the most new money. Think about it. When an everyday investor buys an S&P 500 ETF, their money is disproportionately funneled right into the largest tech stocks simply because they're already large. That pushes their prices up even further, which makes them larger still. And this happens regardless of whether their valuations actually remain tethered to reality. Which brings us to Section 4, the current market and the AI boom, riding the thematic wave. Now, this concentration we've been talking about, it isn't spread evenly across different sectors of the economy, like manufacturing, banking, or retail. Not at all. It is heavily dependent on the continued explosion of artificial intelligence and semiconductor manufacturing. The top companies in the index right now are the exact ones designing the chips, building the cloud infrastructure, and deploying the AI platforms. With over $600 billion committed to AI spending, the stock market has effectively made a highly concentrated bet. It's betting that this specific technological theme is going to continue to exceed incredibly high expectations without a single hitch. But looking at this neutrally, this highly concentrated AI ecosystem is facing several real external pressures. I mean, if demand for compute power slows down, or if the return on investment for that massive $600 billion turns out to be questionable, the whole narrative weakens. Plus, we can't ignore the immense geopolitical risk here. Roughly 90% of the world's most advanced chips are made by TSMC over in Taiwan, so any supply chain disruption there would immediately ripple through the entire tech ecosystem. You add in persistent U.S. inflation driven by strong jobs reports, and you've got a seriously volatile mix on your hands. Someone once said, interest rates are like gravity on the stock market. The higher they go, the harder gravity pulls. And, that is just a perfect metaphor. It explains exactly why higher interest rates put such severe downward pressure on those super lofty tech company valuations we looked at earlier. When central banks keep interest rates high to combat inflation, investors actually have to discount the future earnings of those high-growth tech stocks. Simply put, if you can get a guaranteed risk-free return sitting in short-term bonds, you're going to be way less willing to pay a massive premium for a tech company's theoretical earnings that might not materialize for a decade. Meanwhile, though, the frenzy just continues. We're seeing record-breaking capital raises from private tech giants that are seeking to go public and basically absorb some of this immense market liquidity. We're actually watching a bumper IPO season materialize right in front of us. There are rumors of massive market debuts from the likes of SpaceX, which is reportedly seeking eye-watering valuations of up to $1.75 trillion, as well as other heavyweights like OpenAI and Anthropic. The market is literally being flooded with an immense supply of new tech equity, and it's really testing whether investor demand can possibly absorb the whole shebang. Which leads us to our final section, Section 5, the passive investing reality, and more importantly, what it means for you. Ultimately, this whole evolving structure profoundly alters your actual risk exposure. If the AI narrative starts to crack, the exact same passive flows that push the index up will mechanically pull money right back out of the biggest stocks, dragging the whole market down with them. It's totally a double-edged sword. Think about it. If a massive tech stock faces a big sell-off, passive ETFs have to mechanically liquidate billions of dollars of that exact stock to match the outflows. And because it makes up such a huge percentage of the index, the weight of its fall applies an outsized downward pressure on the entire market. It really diminishes that nice cushioning effect that true diversification is supposed to provide. But despite all these risks with tech concentration, history continually shows us something really important. Remaining in passive index funds still outperforms trying to actively pick winning stocks. Since its inception, the S&P 500 has boasted a historical compound annual growth rate of roughly 9.8%. For the average retail investor trying to time the market or, guessing the exact moment an AI bubble might burst, usually just results in underperforming the very index they're trying to outsmart. Even professional active fund managers consistently fail to beat this simple passive approach over the long haul. So what does this all mean for you? As you review your retirement funds or your passive investments, I want you to leave today reflecting on a key question. Is your diversification actually an illusion? And what do you genuinely own? You might technically hold an index of 500 companies, but a massive portion of your financial future is currently sailing on the success of just a select few tech titans and one single, incredibly powerful narrative. It's definitely something to think about. Thank you so much for joining me on this explainer, and I will catch you in the next one.